Welcome back to Alpha Recap. Markets closed for the day with a broadly neutral tone, but there were pockets of clear winners and losers across sectors. I'm glad you could join us after the close. As always, if you have questions, you can reach us at stockalpha.ai. We answer listener Q&A there. Jessica, great to have you.
Thanks for having me. Lots to unpack from today. Policy headlines, big financing moves, and the usual mix of AI optimism and regulatory caution.
Let's start big picture. How did the tape look when the bell rang?
Overall, it closed broadly neutral, but it felt selectively constructive. Policy wins pushed certain groups higher. Think cannabis, materials focused on critical minerals, and parts of real estate, while regulatory hits weighed on utilities, healthcare, and the crypto space. It was one of those days where you had to pick your spots.
Okay, pick our first spot. Cannabis. That sector had some nice headlines today.
Right. There were a string of wins at the state level. Virginia moved a sales bill forward, a Minnesota judge restored hemp shipping, and Colorado advanced medical access measures. Those are the kinds of steps that expand markets in a tangible way. Fewer supply chain headaches, more interstate commerce, clearer rules for operators.
Why does that matter beyond the obvious? I mean, more stores, more sales, right?
Yes, but it's deeper than that. For multi-state operators and ancillary businesses, regulatory clarity lowers legal and compliance costs and improves growth visibility. That can translate into higher valuation multiples if companies can show real revenue growth and scalable distribution. Investors should watch licensing timelines and any new state tax structures, because those can change the economics quickly.
Got it. Materials and mining also showed strength, driven by critical minerals, right?
Exactly. There was fresh U.S. funding targeted at critical minerals, plus rare earth project wins and more drilling activity, particularly in places like Alaska. Onshoring these supply chains matters for batteries, electric vehicles, and defense applications. Funding and offtake agreements reduce execution risk for projects and make miners more investable.
When you say offtake, explain that simply for listeners who don't live in project finance.
Sure. An offtake is basically a promise from a buyer to purchase future production from a mine or plant. Think of it like a long-term pre-order. That promise helps miners raise money and move projects forward because lenders and investors see predictable cash flow.
Makes sense. Real estate was another outperformer. What moved the needle there?
Deal activity and refinancing were the big drivers. We saw a lot of M&A headlines and rising commercial real estate loan demand. Industrial real estate tied to reshoring and logistics was especially strong. Companies still need warehouse and distribution space as supply chains reconfigure.
There was also a large financing move in communications infrastructure. Vertical Bridge closed a nearly $2 billion ABS. Walk us through why that mattered.
Vertical Bridge completed about $1.94 billion in asset-backed securities secured by tower assets. That's important because securitizations like this unlock big pools of capital, lower financing costs, and accelerate tower buildouts. For tower owners and telecom infrastructure REITs, cheaper capital means faster deployment for 5G densification and edge compute.
So that was a positive for telecom infrastructure and adjacent suppliers.
Yes, but credit investors need to model tenancy and lease deterioration risk. The headline is good for deployment, but it's not free money. The assets backing those deals still need to prove they generate stable cash flow.
Let's shift to the sectors that struggled. Utilities got smacked by an EPA rollback. Explain how that played out.
A broad rollback of greenhouse gas rules introduced policy uncertainty. In the short term, some utilities may have seen lower compliance costs, but the bigger issue is policy whipsaw. If rules swing back or states impose their own stricter standards, capital planning becomes tougher. That uncertainty increases the risk of stranded assets and makes long-term investment in renewables or storage more volatile.
And yet there were positives in the utility space too. Storage and grid AI projects were still getting traction?
Correct. Long-duration storage deals and grid-focused AI work continued to be reported. Those projects are durable because utilities need flexibility on the system. So the trade was clear. Favor utilities with diversified generation, strong regulated earnings, and active storage pipelines. Avoid names that are heavily concentrated in fossil assets unless their valuations already reflect that risk.
Healthcare also had a rough day with FDA rejections and HHS leadership shifts. What was the market worried about there?
Several policy and regulatory moves introduced near-term uncertainty, from FDA decisions to shifts at the Department of Health and Human Services and CMS. Those changes can affect reimbursement, surveillance, and funding. For hospitals and medtech firms that operate on thin margins, even small policy tweaks can be meaningful, so investors pulled back.
Crypto was a classic mixed tape. A price bounce but structural headlines. Summarize that for us.
Bitcoin rallied toward $69,000 intraday, which lifted crypto-related equities like Coinbase and MicroStrategy. But the sector had ugly reminders of fragility. Custody failures were reported, and a Ponzi scheme sentence totaling $200 million was highlighted. That combination of short-term price strength and long-term operational risk kept sentiment choppy.
So, for someone with crypto exposure, what's the practical takeaway?
Size positions modestly, prefer regulated intermediaries with strong custody controls, and separate speculative spot exposure from infrastructure plays. Operational due diligence matters a lot here. Custodial security, insurance, and balance sheet strength are the things to focus on.
AI was all over the place. Shopify had a big number, and Apple adoption was strong, but there were pushbacks and staff churn at other places. How did that theme play out?
AI showed up in multiple ways. Shopify reported about 30% revenue growth for 2025 and rolled out AI commerce tools that seemed to help merchants. Apple's ecosystem metrics were strong, and there was even some fusion news that added to the tech optimism. But there were also legal, labor, and creator pushbacks. Remember, AI can boost productivity, but it can also create content liability and labor friction. Investors need to tell apart AI winners, platforms that can monetize AI via subscriptions or transaction fees, from platforms facing legal and margin risks.
That feels like a critical distinction. Any simple rule of thumb?
If AI directly creates recurring revenue or durable monetization, for example, enterprise software or commerce platforms charging for upgraded services, that tends to be higher quality exposure. If AI primarily powers free content or ad-driven models with big legal uncertainty, that's riskier.
We also saw renewable auction news from Germany and the Philippines. What did those tell us?
Germany awarded about 2.3 gigawatts of solar at record low prices, and the Philippines unveiled plans for about 25 gigawatts of auctions. Those signals pointed to improving price discovery and project economics for solar developers, which is bullish for developers and equipment suppliers. But it's not a free lunch. Financing and permitting still matter.
Let's get practical. You boiled out 5 or so major moves in the note. Can we run through them quickly and why they mattered?
Sure. 1. The cannabis state-level wins expanded addressable markets and reduced compliance risk. 2. Vertical Bridge's about $1.94 billion ABS unlocked capital for tower buildouts. 3. Shopify's roughly 30% revenue growth and AI tools signaled sustainable merchant monetization. 4. The EPA rollback created policy uncertainty for utilities even as storage and grid AI projects continued. And 5. Critical minerals funding and rare earth wins supported the materials complex and onshoring efforts. Each of those had clear investable implications.
You mentioned some actionable investor insights in the note. Let's translate those into something listeners could actually act on. High level, what did you recommend?
High level. Favor sectors with explicit policy or capex tailwinds, materials, industrial suppliers tied to reshoring, and industrial or logistics real estate. Differentiate AI winners from platforms facing liability risk and take a barbell approach in energy. Balance renewables exposure with selective energy transition equipment suppliers. In crypto, do detailed operational due diligence and keep position sizes modest. And for utilities and healthcare, hedge regulatory exposure or keep positions smaller until policy clarity improved.
When you say barbell and energy, give an example of how a listener might implement that with a couple of concrete ideas.
Think of it as balancing. On the renewables side, favor developers or equipment makers that benefit from improving auction economics. On the other side, avoid large directional oil bets unless you saw clearer macro demand signals or OPEC plus action. So maybe increase exposure to project developers or inverter and module suppliers, and keep only a tactical, not strategic, allocation to oil producers.
What about real estate? Any quick rules there?
Target REITs with long-term leases and industrial or logistics focus. For commercial real estate, monitor CRE loan trends and refinancing costs. Prefer operators that can lock in fixed-rate financing or have low near-term maturities.
You flagged a few risks that could change the narrative. Let's list them quick.
Major risks were rapid policy reversals, say state or federal backtracking on cannabis wins or the EPA tightening again, interest rate surprises that would pressure real estate and growth tech, geopolitical shocks that could disrupt critical mineral supply chains, swift AI regulation that dents ad-driven platforms, and aggressive crypto enforcement that hurts asset prices and custodians.
Before we wrap, any short-term items to watch in the next month or two?
Yes. Watch state-level cannabis legislation and licensing timelines, EPA implementation updates, and possible state responses, Treasury or Energy Department announcements tied to renewables and grid AI financing, retail earnings for signs of AI-driven margin expansion, and any crypto custody rule changes or enforcement actions.
All right, let's close with the big takeaways for listeners who want a short checklist to remember from today.
First, policy still moves markets. Favor companies that convert policy tailwinds into contracted cash flow. Second, capex and financing are driving pockets of activity. So look at suppliers and REITs tied to those cycles. Third, differentiate AI winners that monetize versus platforms facing legal risk. Fourth, balance energy exposure between renewables developers and selective transition suppliers. Finally, manage crypto and regulatory exposed names with operational checks and modest sizing.
Perfect. Thanks, Jessica. Quick sign-off. Any closing thoughts?
Be active, but selective. Position sizes mattered more than usual today, given how quickly policy headlines could re-rate companies. And keep an eye on financing and licensing timelines. Those will show which winners have durable momentum.
Great. That's it for today's sector recap. If you have questions about anything we covered, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening. We'll be back after the next close with more highlights.